Okay, good evening, everyone. Welcome back. You hear me?
Yes, sure.
Okay.
Good evening.
Okay, so sorry that I could not hold lecture last week because of my health. You already know. So we continue lecture 1, and I already posted course online in lecture 2. You can find it there. So we continue the lecture 1. I think everyone got a slide. So from the first part, we talking briefly about what we study in international finance, including balance of payment, and the most important part is on the exchange rate and foreign exchange market. So in lecture 2, we will go deeply into foreign exchange market. And then lecture 3, we looking at the balance of payment, which is very important in international finance. You can looking at the course online. Sorry, so let me show. Okay. So here, next one we looking at the foreign exchange market. I mean in the second sessions today. Then if we can finish, uh, we finish. If not, we can keep it for next week. And then we go into balance of payment, and we're looking at international monetary arrangement, which I think you already know in previous course. So we just go very brief and very quick on that. Then we're looking at monetary and financial systems. It's also more like a review back to what you have learned before. Then you learn in macroeconomics, probably in um, IE405 as well. So we just more like review on what and then add some new things there. Then we look at commercial bank. Specifically, I think I take commercial banks specifically here because I think in Cambodia we are not really financial market not really yet developed fast. So banking system is still dominant. That's why I choose just looking at commercial banks. And then we're looking at risk management in financial institutions, including credit risk, liquidity risk, operational risk, and other risks. Then we will look at some important indicator that show us about the the strength of the financial system or the banking system. So we're looking at the capital adequacy, liquidity, leverage ratio, and then some way into the Basel III rule. And we also touch on the fintech and the central bank digital currencies because I think it's their hot issues, hot topics, hot issue as well, and a lot of debate on whether uh, central bank should issue digital currencies or should not. So we will be looking at that as well. And then you will have a presentations which we looking at um, the crisis in the global economies, including Asian financial crisis, global financial crisis, the Europe debt crisis, and then we touch on uh, the lectures, the chapters in the books. I think you already have the book, the second part of the books, which they're looking at the emerging market financial crisis and the second reform. Then we for the next group is the third reform and international financial architectures. And the last group will be on the global pandemic crisis, which will be a little bit different as we mentioned before. And then you also have a individual assignment as well. I will post it probably next week together with the group assignments so that you can start working on the um, preparations. So if we cannot finish on time, probably we can do somewhere during the makeup class sessions. If we cannot finish what we plan in the syllabus. So that's all I think in the course outlines. Any questions?
Hello, teacher.
Yes.
Why quizzes and class participation account for only 1%?
Yeah, because I think here I'm not sure we have time to do the quiz. Actually, I just put it there. So that's why I just put it with the class participations.
Um,
And with
I,
it.
I mean, it accounts for only 1%.
Ah, okay, I got it. I got it. Maybe some I will change it. It should be 10. It should be 10. Sorry, so quiz and class participation should be 10. Maybe the typo. Thank for informing. Thank you. So here the quiz and class participation will be 10, right? Maybe a typo without 0. Sorry. Any more questions? So if no more questions, so as I mentioned, probably we do not have time. Let's see if we can do the quiz. We will do. If not, we just take the 10% on the class participations. Okay, so we continue the lectures here. So in this part, we're just looking at how international finance is important for development, specifically for we could say economic development here. So actually, before the GFCs, policymakers in central bank or in Ministry of Finance or Treasury, we don't care about each other. We just do what our objective to do. So central bank, they just focusing on monetary policies, interest rate, exchange rate, something like that, or supervisions. And then Ministry of Finance or Treasury, they just focusing on fiscal positions. They're just looking at the balance of payment, deficit, something like that, or economic growth. But after the GFCs, actually, it shows us that the international finance or the financial systems actually actually can pose a risk to the real economies and as well as the whole global developments because there's a before that we don't know that actually there is a linkage between the macroeconomic and the financial systems. So after the GFC, we're not only looking at macroeconomic risk or financial system risk alone, but we also now looking at the what we call macro financial linkage. What is the feedback loop between from macroeconomic into the financial systems and the financial system into macroeconomics? And then we do stress testings also on the macro levels. In addition to that, before the central banks or the supervisors, um, the 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 um, the supervisions of bank and financial institutions, we believe that we are more on micro levels. So we don't care about how the economic going. But after the GFC, it's shown us that actually the financial system, the banking supervisions actually need to do not only on the micro level, but we also should do it on the macro level as well. So now the policymaker not only focus on just the monetary policy or the fiscal policies, but we also focusing on what we call the macro-prudential policy as well. So the GFC actually teaches a lot of experience. And the after the GFC, there's a lot of efforts by the international community like FSB, the IMF, the BIS, for example, to implement the reforms, especially in terms of financial regulations. But until now, we can see that there are still significant risks that remain in the financial system, in the global financial system. So the risks including the vulnerability in bankings and shadow bankings, as well as in short-term capital flows. There has been in the global imbalances because you see um, from the trade protectionism, trade tensions that pose a global imbalance. And then there's also a weaken in physical positions and the sovereign debt overhangs. So after the GFC, even though some of the country, even though I would say most country has bounced back their economic growth, but as I mentioned before that the economic growth after the GFC has not bounced back into the pre-crisis level. And the consequences of the crisis has put some country into vulnerabilities, such as, for example, sovereign debt overhangs. You can see the example of Greece and some of the country in Euro areas. And you can see some countries have a weakening in physical position as well. And we see some of the vulnerability in capital flow because especially from the advanced economies. And then we still see a risk in shadow banking, in banking sectors, especially in shadow banking, because we do not really have a clear or explicit policies or regulations to regulate or to supervise shadow banking. That's why we don't know how much it will pose the risk into the financial system. So the risks remain even though we have done a lot of reforms. And at the same time, so uh, the international agendas, they have highlighted the enormous need for financing for social, economic, and environmental dimension for sustainable development. So now, for today agenda in most of the international conference, they're looking at a more sustainable financing developments, a more sustainable financing for economic developments, not only for economic development, but for social, and they also including the environmental as well, like climate change that require a lot of that now attract a lot of attentions in international forums. So the long-term financing will be essential for raising the resource that the country require for a transition to a more green economy and promoting sustainable financings. But today, up until now, the financial system, the global financial system is actually uh, has not yet allocate the resource for long-term sustainable development need yet. So there has still been an insufficient investments in some of the critical areas, including infrastructure, health, education, sanitations, for the poor, SME, small and medium enterprise, financial service, or we can say financial inclusions, green technologies that have to address climate change for developed and developing countries. So in both developed and developing country, they still doesn't have sufficient investments uh, uh, for for their country developments in terms of, for example, in developed country, they should have sufficient investment for green technology that they can address the climate change. And for developing country, we can see that we still have a lot of areas that we need investments, infrastructures, for example, health, education, sanitation, and improvement in small and medium enterprise and financial inclusions. So the global pandemic crisis or the COVID-19 has shown us that um, most of the country they don't really invest more in health science, for example, and and also in small and medium enterprise investments. So you see that the SME is play an important role in boosting the economy. So after the COVID-19, most of the country they have revisiting their policies. So Cambodia as well, we have put out the policy for economic revitalizations. We we want to focusing on the more sustainable economic growth, especially we now really promoting the SMEs. So you can see the Ministry of Finance has rolled out uh, 3 times of the financing for improving the SME and providing finance to SMEs. So uh, we hope that in the future or in the near futures, SME we have to get a sufficient investment to further expand their business. And SME provide a lot of job opportunities for people in the country, and especially in Cambodia, you see a lot of more than about 70% of the business in Cambodia is in terms of SME. So you can imagine how much job they created for people. So we see that there's still a financing need uh, from both developed and developing countries. And the challenge that lie in promoting the global financial system that hope that have to incentivize the such a reallocation of the sustainable manner is actually building on the stable domestic capital market for long-term investment in developing countries. And the ultimately at the end, actually the stabilities the sustainability and the inclusiveness of the financial system is actually mutually reinforcing. So stable and inclusive market encourage greater investments, while the long-term investment can play as a stabilizing and counter-cyclical role in financial market and in the real economies. However, there's still a trade-off exists between how the policymaker can reduce the risk in the financial system, while at the same time they want to enhance the access for credit in achieving sustainable developments. So it's easy to say we want to have greater investment, we want to have stability, sustainability, and financial inclusion or inclusiveness. But if we're looking at in the realities, it's hard for policymakers to mutually reinforce these three objectives at the same time. Because, for example, while you want to have more investment, if the banking sector, for example, they lower the interest rate, they give out a lot of credit to the economies, then there might be a risk, because there might be a risk that the bank can lend out to customers that are not viable, that they're actually not able to pay. So it's a risk for them as well. So even though we want to have the three objectives together, but it's hard. It's a trade-off between minimizing the risk and enhancing or increasing access to credit for sustainable developments. So it's hard for the policymakers to make the decisions. We want, but the policy that we put forward, is actually we trying to minimize the risk as much as possible, and at the same time increasing access to credit for um, uh, supporting the economies. So in here, we're looking at the global imbalance and the international reserve accumulations. So these are all in the area of international finance. So the global imbalance have narrowed but remain an issue in the long run. So especially on the current account of major country is narrow. It a general trends in financial crisis uh, 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 with only some countries that have temporary reversals in 2010s. So you can take the US, for example, um, as a example of the country that still have a reverse trend in on their current accounts. So narrowing in external surplus of China actually, for example, for China, are reflecting in a part in a more flexible exchange rates. So the global imbalance are not expected to widen by a significant margin, but much of the structural issue is actually underlying the global imbalance that can pose to long-term economic stabilities. And the global imbalance actually have the interlink with the increasing in global foreign exchange reverse in the last decade. So we can see increase more than fivefold from 2.1 trillion to about 11.7 trillion between 2000 and 2012. So uh, after the GFC, we can see that in the reserve actually fell across the region following the crisis because country need to how to say, they need to take out their reserve in order to maintain their economic growth or to balance their economic stabilities. So at the same time, uh, 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 the the reserve decreasing actually, I mean, globally might be owing to a large increase in reserve accumulation in the Western Asias. Um, such as developing country and the economy in transition, such as China, for example, they have huge accumulations in their international reserve so far. So this is the foreign exchange reserve. So you can see there have been an increase in Western Asia's here on the green line between 1992 and 2012. Uh, uh, so then we see the trend in international private capital flow, or we can say capital flows. So for attracting a stable and long-term private investment into developments, such as human resource and infrastructure sectors, including transport, energy, communication, is actually increasing the importance. It's important for the developing country in order for them to accomplish sustainable development. So for developing country, because the financial market is not really developed or at early stage of development, they are still relying on a more stable and long-term investment, such as foreign direct investments, in order to enhance their economic sectors, such as human resource, education, infrastructures. However, until today, there is a significant share of private capital flow to developing countries actually have found to remain short-term oriented in some of the countries, which is most of them are not inappropriate for long-term investment need, or we can say not really sustainable and not for the developments. So sustainable finance imply that a shift in financial sectors to make sustainable development, including the three pillars like economic, social, and environmental, is actually play an important role or play a central concern in the global financial sectors. And so now, before we actually focusing on relying on the foreign direct investment, but now there is also a shift in the financing from the financial sectors that we hope that the financial sectors will provide financing in a more sustainable ways for economics, for social, and for environmental as well. So before, we are not looking at ESGs. I mean, the banking sectors, the financial sector, they're not care about the ESG, I mean, the economic, whether they're finance providing to economic, to social, or to environments or governance. But now, ESG play an important role as well in the financial sectors, because banks are now also consider whether the finance, the credit that they provide to the business is whether they uh, 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 contribute to economic, contribute to social or environmental development or not. So that's why now there is a shift from relying on foreign direct investment to relying on financing from the financial sector. So while the financial industry, as I mentioned, traditionally they focus on only creating their economic values. Their short-term investment has meant that they have overlooked the long-term value, the sustainable ESG, as I mentioned, and now they already make a shift from relying on creating only their economic value, I mean profits, to a more sustainable practices. They're looking at economic, social, and governance, or we can say in environmental. However, the short-term investor, they have considered both developed country capital market and as well as the volatility in international capital flow to the developing countries. So because the developing country we relying on the advanced economies, capitals. So there's still a volatility in the capital flow because in advanced economies, the economy is also remain vulnerable as well to the global imbalance as we mentioned before. And in terms of the cross-border capital flows, we can see that there are some revival in cross-border bank lending to developing countries. With the bank in euro areas still facing deleveraging. I mean, although some of the bank in euro area they facing deleveraging pressures. And then, as I mentioned, the foreign direct investment, the FDI, remain strong, remain relatively strong and stable to those developing countries, and it play an important role in development, particularly because it contributes to promote employment, new sector, linkage technologies, transfers, and capability accumulations. But there's some evidence on the impact of the FDI on the domestic economy as well. In some countries, they experience positive spillovers, and there is a evidence that the government policy play an important role in facilitating the spillover. So even though we say FDI is important for development, for creating employment, creating job, but FDI may also pose either positive spillover or negative spillover to the economies. So whether FDI can pose a positive spillovers to the economy depends on how the government accommodate the policies on at the same time with the inflow of the FDI. So, for example, the government might have explicit policies such as the local content requirements, training requirement, and mandate that join the research and development program, which at the same time they have to promote positive spillovers. And we notice in some countries like China and Singapore, for example. So in Cambodia, we also now trying to revisiting our policies. So if you study in trade course, you also encounter the what we call the industrial policies, investment policy, IDP, that we have revised the policies because we want to have a more sustainable development. We want to take up the benefit from the investment from the FDI, for example. So the IDPs, the revisions of IDPs play an important role in creating a positive spillover from the FDI, from the investments, as we mentioned here. And then the cross-border capital flow can be in terms of portfolio flows. So for Cambodia, I would say portfolio flow is very minimal. It's still minimal because our financial market is still at the early stage of developments. But in country that they have developed their financial market, the portfolio flow is remain volatile. So you remember during the GFC in 2009, 2010, the developed economy, they do a lot of unconventional monetary policies, or we can always say quantitative easing, in order to support economies, to spur economic growth during that time. So when they do unconventional monetary policy or QE, meaning that those advanced economies during that time, they lower the interest rates. So lower the interest rate to almost zeros. So when advanced economy, they lower the interest rate, the investors, they decide to invest, to put their investment in developing economies. So quantitative easing of QE or unconventional monetary policy by developed economy have led to a surge in portfolio flow into developing economies. But later on, those developed economy, they conducting a tapering. Tapering means they stop providing or implementing unconventional monetary policy, or we say they start to raising interest rates. So when they start to raise the interest rate, the investor now also move out the capital from developing economy into developed economies. And then later on, those advanced economies, they start the easing again, which led to another surge in inflow into developing economies. So you can see just during several years, the policy from developed economies have posed volatilities in portfolio flow into developing economies. And then in the mid 2013, again, they expect that there is an end of QE in the US. So the US start tapering again in 2013. That they led to a lot of sell of the financial asset in emerging economies. So this pattern of expansion and retrenchment in portfolio flow underscore the volatility in international capital flow, as well and at the same time, it underscores the spillover effect of advanced economy policy on developing economies. So the policy from advanced economy is really important because the developing economies still depend on the capitals, the cross-border capital from the advanced economies. And you can see just during several years, they have been easing, then tapering, and then easing, and then tapering again. So it poses a risk to those developing economies. So recently, there is an expectation to end QE that proved to be premature during that times. So the normalization of monetary policy condition in developed country over the coming year may lead to a continued retrenchment in portfolio flow for developing country as well. So even though some of the advanced economy are still in their um, expansionary monetary policies, but we expect that at one time they will start to tapering again. So normalization of the monetary policy in developed country will again have an impact on the developing countries, even after the COVID-19. So after the COVID-19, you see some advanced economy, some developed economy, they start to have an increase in inflation. So central bank in those advanced economy, they start to consider about taperings or to end the QE, or we say they start to have normalization in their monetary policies. So then for us, for developing country and emerging economies, we remain vulnerability while the COVID-19 still pose a major economics downturn in our economies. So when you are small, you just follow the big countries. That's why you can see the reason the current tensions between Russia and Ukraine, and you see clearly that some country they already take sides. So because Ukraine is still small open economies, but it's one of the important country in Europe. And then some of the countries they take sides. So some of the country they provide support, aid to Ukraine. Some of the country they provide um, the the stuff for their soldiers for fighting with Russia. So either way, I think it poses the global imbalance around the world, because now some country that they take side, they start to freeze Russia's bank accounts, Russia's bank and financial institutions in most of the country, in some of the country in Europe. So you can see these are all may pose a risk into the global financial systems just from the trade, just from the tensions between the two countries. And then you can see that if you want to check what happens, so now you can see that the oil price is increasing, the world oil price is increasing, and usually in economic theories, when the oil price increasing, the gold price should be in reverse. I mean, when the oil price increasing, gold price should going down. But these times it's special because gold price and oil price together are increasing. So the tension between Russia and Ukraine has posed an increase in gold price because investors they are still reluctant to invest. So they want to invest in a more stable assets, which is gold. So they start buying gold, that making the price of gold not going down, which is special uh, 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 these times. So if you want to see more, you can check the data and plot it and see the difference so far between the oil price and the gold price. And cross-border capital flow maybe can be in terms of bank lending as well. So there have been a bank lending, cross-border bank lending to developing countries, but those cross-border bank lending still remain subdued and volatile. So short-term commercial flow to many developing countries has been the most volatile in terms of capital inflows, and they're experiencing a more surge and then a reversal cycle than any other type of flows. So lending to large countries with open capital accounts such as Brazil and South Africa has been particularly volatile because even Brazil have its large country is among the emerging economy, but Brazil still remain volatile because of its economic policies or economic conditions. So the net commercial bank flow to developing countries remains subdued as a number of international banks, such as those in Europe, have continued to face a significant deleveraging pressures. Because they experiencing a debt overhangs. So the European Central Bank start to ask the bank and financial institutions to deleveraging their debt. So it has reduced the cross-border lending activities, especially in emerging economies that depending on bank from the euro areas. So in Cambodia, we actually have a cross-border bank lending as well, especially to the MFI, but those bank lending are mostly in a form of long term, more than 1 year. So usually between 5 and 10 years. So we consider it's still a stable financings, stable borrowings, and for the MFI, they also have a lot of bank lending from the euro area as well, like such as Luxembourg's, Denmark, for example. So those countries, they invest in developing countries, especially in not in much in bank, but in MFI sectors. That's different from the other country because Cambodia is uh, a little bit special. And for so commercial bank, they play an important role in financing the long-term projects in developing countries. This is especially the case for infrastructure investments in countries where the corporate bond market are relatively underdeveloped and unable to raise required levels of long-term financing, so such as Cambodia. So that's why the credit or the financing from the banking sectors play an important role in supporting the economic growth, while the financial market still at the early stage of development. So uh, 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 that's why in the course outline, I take the lecture on just the commercial bank alone. So there is a lot of debate in when I meet the IMF or the Emerald, Moody, for example, they ask, you have a high credit growth, uh, you have a large banking uh, sectors. I mean, we have a lot of bank and financial institutions. So more than 50 banks, more than 200 MFI. So, but the question is, because Cambodia is now at the stage of developments, at a stage of moving to economic growth, moving our economic growth, we need financings. So if you're looking at the financial market, the security market, you see there are not many activities there, even though they have several company listed, but the area that they need a huge financing, such as infrastructures, they cannot go to financial market listed and raise the funds. So what they can do, where they can find, is actually the banking system. And we agree that we have a large banking sectors, but those institutions, they come for different business models. Some bank play as a wholesale bank, some bank are a retail bank, some bank are urge for going for big business, while some other bank, they just looking at the SME, for example. And we have more than 200 MFI, which is another different areas, dimensions. So MFI more on increasing the financial inclusions and reducing the poverties in the rural areas. They provide only small, micro and small financing for the business. They provide financing for micro and small business most of the time. So even we have a huge banking sectors, but they have different business model, different objective. I mean, so, but we still actually, the NBC still remain resilient. We are more proactive, even though we claim that, but we still perceive a risk as well. So we are more proactive. We have regulations to those bank and MFI. So it's just an example that the case for Cambodia. So any questions so far?
Teacher, can you explain again how the price of gold increased?
So I should have the data here. So usually in economic theories, we say when the price of oil increases, the price of gold is decreasing. It's a theory, because we need more investments. So when the oil price increasing, I mean the business they need finance to respond to the increase in the oil price. So then they need to sell assets. So usually a lot of gold sell in the market, then the gold price going down. It's a theory actually. But currently now the oil price is increasing, but you can see the trend of the gold price doesn't really going down actually. It's still increasing. So the question is why? This happened because of political economy, politics happens. The tension between Russia and Ukraine. And Russia is one of the countries that use oil as well. You already know. And so the tension between Russia and Ukraine make investors reluctant to invest. You see a lot of tension going down among Europe, among the US. They freeze Russians, bank and financial institution companies. So during this time, at this time, the investor would like to invest in a more stable assets. Usually, they invest in gold. So when they buy more gold, when people demand for more gold, the price is increasing. Good. Am I?
Yes, yeah, teacher.
Okay.
I got it, teacher.
So the international capital flow can be in terms of remittance as well. So remittance flow usually happen only from advanced economy or developing economy into developing economies. So remittance flow continue to increase, but the cost of sending remittance is reducing. And the question is why? Because the technologies have people or have their payment system more 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 cheaper. So the cost of sending remittance now is reducing. So you can see, imagine 10 years ago, if you want to send money or if your relative send money to Cambodia, for example, they need to spend a lot. They do like Western Union, MoneyGram, for example, but now it's really easy just through the payment system, through bank, for example, that have the remittance flows increase as well. And remittance are actually private flow, which is more related to personal transaction, especially from migrants to friends and families, and they are recorded in income balance of the current account. So when we're looking at the balance of payment, we will see there is a point, there is an item there, remittance. So the remittance is important for developing country because they flow directly to household, and therefore they have an effective role in reducing poverty and financing the imports. But sometimes they have limited direct impact on the investment at the microeconomic levels. So from so far, if we see FDI, if we see portfolio flow, we see cross-border lending, they are more to direct impact on investments and macroeconomics levels. But remittance, because it's a more personal transactions, it's directly to household. You cannot see its impact, huge impact on investment. But it have an important role in reducing poverty and financing the imports that have a indirect impact on the investments. So in the last decade, the remittance to developing countries has become increasingly relevant as a form of cross-border financing, and remittance are larger than private debt and portfolio flow in some of the countries, and they are more than twice the level of the ODA for developing countries. So the country that um, uh, 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 country that have a lot of migrants to the other countries, you see a huge item in current accounts balance in remittance. But in developing countries, you see the remittance really minimal. So that's the difference between remittance in developed and developing countries. And so remittance have been a more stable than capital flow, actually, and they can be a counter-cyclical source of balance of payment financings if the country is having a huge migrants, and they playing as a macroeconomic stabilizing role as their level is more dependent on economic situations in the host country than in the recipient countries. So remittance is really important for developing countries. And you can see Cambodia, we also have migrants that going other country and work, and they have transfers amount of their salary to their families, to household. So at least it's a source of income for the household in Cambodia, for the family in Cambodia to start business or to start a small business to maintain their consumptions, for examples. So for developing country, remittance play an important role. It's even twice the level of the ODA or the official development assistance. So then, you see that there's a lot of volatile capital flows. So the policymaker have actually have implemented policies to manage the capital flows, and also in terms of international levels, they also strengthening the international financial regulation as well in order to minimize the volatilities in the capital flows. So the GFCs have prompted governments and the intergovernmental community to undertake a number of important reform in financial sector regulations. So the ultimate goal of the financial system, we already know, is to facilitate the flow of the fund from saver to borrowers and to effectively collect allocate funds throughout the economies. So safety and soundness of both individual institutions and the financial system is crucial for the efforts in strengthening the international financial regulation. So we'll be looking at that, the role of financial system in the next lectures. So at the same time, however, the financial system, they also need to address a broader goal of access to credit if it effectively contributes to sustainable development. That's why I mentioned that before we don't care. The banks, they don't care what sector they uh, provide credit to, but now the big bank, they included the ESGs in their credit policy as well. So whether they also consider whether the sectors that they provide or the business that they provide, it can contributing to economic or not, contributing to social or contributing to green financing or not. And reducing the risk while promoting access to credit, again, is a trade-off. It's a challenge for policymakers, as I mentioned earlier, because it's a trade-off. While you want to increase in credit, and at the same time you don't want risk, it doesn't happen. So it's a trade-off. It's a challenge for us. Yes.
Teacher, why does it why increase in credit leads to increase in risk too, teacher?
Yeah, it's a good question. So, for example, if we say now we're increasing the credit, so the banks, they want to increasing their credit, they want to increase the finance. What they can do is they lower the interest rate, they lower the criteria for the customers. So like before the customer, they need to complete 5Cs, for example, or 6C, for example. They need to do a lot of credit worthiness of the customers. But because they want to increase their credit, they lower their standards. When they lower their standard, they may face a moral hazards, or they may face the asymmetric informations, because when they lower their standard, they might face customers that do not provide enough information or do not have enough capability to pay. So when they just want to having a more credit but they lower their standard, they may face a risk of default from the customers. And they might have face a credit risk or increasing in non-performing loan, for example. That may affect their capital, liquidities, and so on. It's in a systemic risk as well. Am I answer your question or you understand?
Okay, teacher, I do understand. Thank you, teacher.
Yeah. So it's still a challenge for us again. It's hard for policymaker. That's why when we issue any policies, people say, why you don't do this? Why you don't do that? It's hard for us to decide actually, because if we are too optimistic, we may face a risk in the future. So even though we claim that the banking sector in Cambodia is safe and sound and resilient, but risk is something that we don't know, something that we cannot foresee. Even we have foreseen some risk, but there is a risk that we do not expect at all. For example, who expect that we will face the COVID-19 crisis? We don't expect. And everyone just focusing on maintaining economic policies, maintaining financial stability, but then the unexpected event happens. And it impact on all of the dimensions in economies, financing, fiscal policy, because government has to spend a lot on preventing the COVID-19 spreads. They need to increase their expenditures. And increasing expenditures is a risk to the governments. At the same time, the economic is going down, we don't have any revenue. So even though we claim that the banking system is safe and sound, but we don't know what happens. So we still need to be proactive in what we are doing. So the regulatory and policy framework need to strike a balance between stabilities, particularly we want to reduce systemic risk, and at the same time balance the access, especially for long-term investment, in order to ensure that the financial system they work for the sustainable global development. So there's a lot of reforms so far in the international financial regulation, reform to the banking system. We will talk about it later. Especially we move from the Basel II to Basel III. Countries start to regulate shadow bankings. And I'm sure you already know what is shadow banking. I think you learned in the previous course in IE405. So policymakers, they start to implement policy that regulate shadow banking, even though it's limited, but at least they implement some of their regulations. And then people start to regulate the derivative market. So before the GFC, we overlook the importance of the derivative markets. So before the GFC, people invest in subprime mortgage. Subprime mortgage is one kind of derivative. Then the banks, because they want to hide from the policies, from the supervisors, from the policy makers, so they put it in the off balance sheets. And before the GFC, we do not really have regulations or imposement on any item of the balance sheets. On the off balance sheet items, we only looking at the balance sheets, income statement, for examples, but we are not looking at the off balance sheet items. And then after the GFC, we start to regulate the derivative market. We start to looking at the items in the off balance sheet items that can pose a risk to the financial system as well. So we do have reform in Basel. I think they start to looking at the off balance sheet items, and then we regulate credit rating agency in industries. So before the GFC, no one regulate credit ratings agencies. So they just go by themselves. They can rate any bank, they can rate any financial institutions without regulating, without any supervision. But then later on, because the misconduct of the credit rating agency has posed a risk, has one part play a role in the GFC as well. So the reform is that we start to regulate those rating agencies to minimize inherent risk in the financial systems. Because during the GFC, those credit rating agencies, they fail to properly assess the risk of the debt obligations of the subprime mortgage during that time. So that's why there's a lot of questions after the GFC that what are those credit rating agencies doing? So then we start to have regulations on the credit rating agencies to minimize any risk in the futures. And then the last one is the financial inclusions, which is the primary goal of an effective financial system. And before we actually has not been fully incorporated into the reform agenda, but later on, it raised the we see its importance of access to finance, importance of financial service for all the peoples, um, not only those in the cities, but those in the rural areas. It's also important for them to include them in the financial services. And I think, but at the same time, there's no one size fit all approach for building an inclusive financial system. So it depends on countries, uh, developments, country economics. So you can say during the last 10 years or probably 5 years, Cambodia have increased the financial inclusion, especially to nationwide electronic payment systems. And while other actually they focusing on the credit on SME, for example, and we are now looking at the credit for SME as well. And financial inclusion does not only count on just access credit, but it also include other areas like the quality of the service, the financial educations, the consumer protection as well. It's also one part of the financial inclusions. And Cambodia, we also looking at the access of credit for SME, we looking at the increasing in the modernize our payment system. You can see for the last 5 years, the payment system is improved a lot. And then we're looking at the financial educations. If you follow on the NBC website or Facebook page, you can see we do a lot of financial educations program, like Let's Talk Money. We work with the ministry, various ministry like Ministry of Women's Affairs, Ministry of Educations, to include the financial educations in the general education systems. And then we are now working on the consumer protection. So we have established a unit, deposit protection units, which also one part of consumer protections. And then we have create a group of people who deal with the customer complaints about or question and complaints about the financial system. So we done all this, but it doesn't mean that other country they don't like us. I mean, they do like us. They may do others focus or dimension, like just for Thailand, they usually financial inclusion for them is the access for credit for SME, especially. So it might be a little bit different. I think that's all for this part, the international finance for developments. Any questions? Or maybe I talk too fast. You can ask me to talk it to explain again.
Hello, teacher.
Yes.
Um, um, I'm okay with the lecture, but I want to ask, in the book, which chapter should I read?
I will
Yep.
post it the report, the chapters later. It's not in the books.
Okay, teacher. Thank you.
Okay. So if no questions, probably we could take a 10-minute break, and then we can continue the next lectures. So we can come back at so now it's 6:45. We can come back at 7:05. Is it good? So we will start again on at 7:05. Okay, we can take a break for everyone.
Yes, teacher.
Okay, thank you. Okay, so everyone, welcome back. I hope everyone have the lecture in your hand. Um, okay, chapter 2 or lecture 2, we're looking at the foreign exchange market and the exchange rate. Um, because it's one of the important topic in international finance. We examines the foreign exchange market and where the exchange rate are determined. So, but I think some of the theories you already learned in the IE405. So we probably going a bit. I'm going really brief, probably also a bit fast as well. But if you still think you don't understand or you want me to repeat, you can do it. So the foreign exchange market, I think the exchange rates actually affect the economies and our daily life. And most of the countries of the world, we have our own currencies, like American, they have US dollars. The Europe, they have euros, except the UK. And Brazil, they have a Brazilian real. The same name, a Cambodian Khmer real, and then China, they have renminbi, and then Japan, they have yen. So the foreign currency exchange market is a trader of the exchange currency of one country for another currencies. We already know this one. And the exchange rate market is actually they transfer the purchasing power between currencies. If you notice, and they provide credit for foreign transaction. So participant in foreign exchange market we already know, including international bank that specialize in foreign currencies, and those international bank they transfer billions of foreign currency with other banks. And participants can be persons or business that engage in international trade and commerce, especially those involved in imports and exports. International travelers, they may need foreign currency to pay for goods, for lodgings, for accommodation, entertainment in foreign countries. And then we know that central bank and government also involved in the foreign exchange market as well. And we have international investor who invest in foreign currency that they're seeking for a greater profit in foreign countries. So this is just an example of the exchange rate. So the top picture, the top graph is the U.S. nominal broad, the nominal broad U.S. dollar index. So the nominal broad US dollar index is actually a trade weighted exchange rate. I mean, they weighted between the US and their trading partners. So going down mean depreciations, going up mean appreciations, and the shaded areas indicate the crisis. So during this time, we already know it's the GFCs. During this time, we already know it's the pandemics. So you can see so far, the US is having appreciation against its trading partners. That's why explain why UF has current account deficits. US imports a lot because imports is cheaper for the US consumers. That's how we link the condition in the countries. Then the down left graph is the Chinese renminbi to US dollar spot exchange rate, mean $1 Chinese renminbi per US dollars. So you can see at some point it almost fixed, and then it crawling, and then it going down here. So this is for China, for renminbi, and this one is the shaded area is indicated the crisis as well in the US. And this is the Japanese yens per US dollars. So you can see the difference between renminbi and Japanese yens. At some for renminbi, you see at some point they almost fixed, but for Japanese yen, because it adopt floating exchange rate, you see they floating against the US dollars, and the shaded areas also indicate the crisis as well in the US. So this is just an example of the exchange rate, how exchange rate look like. So why exchange rate important? So exchange rate important, as I specify many times. So exchange rate are important because they affect the relative price of the domestic and foreign goods. So import and export demand are actually influenced by relative price. So for example, appreciation of a country currencies, they raise the relative price of its exports, while lower the relative price of its imports. Why we say relative price here? Because we weight it against the trading partners. That's why we use relative price. And so the appreciation of a country currencies, they can make domestic business less competitive because the export is cheap, is expensive. So the demand for exports from for the countries must be less than before. So the business might suffer. The smaller company, the smaller business need to go bankrupt or shut down. Only the monopoly or the oligopoly is there in the economies or in the markets. So it makes business, it makes productions less competitive. And then it also provides benefit as well. It benefits the domestic consumers because they can enjoy really cheap import from the other countries. So the policy, the exchange rate policies is really important for the economic policies, whether you favor consumers or you favor the business of the productions. So that's why, again, if we go back to trade war between US and China, there are a debate that China trying to depreciate their currency because they want to boost their exports. Then there's a lot of debate from the manufacturers in the US that against China. But actually, what the US do is their policies. It's not from the other countries. It's just itself. So while they always try to blame others, but actually what happened is decided by their own. So the trade deficits in the US doesn't come from China itself alone. I mean, it's actually come from the US as well, because the US exchange rate is appreciate against other currencies, you can see, and it can answer to the question why the US enjoys a lot of import, and US actually import a lot from other countries. So this is just the exchange rate in international transactions. It's just an example of the exchange rate and the relative price of American designer jean and British sweater. It's just an example. So exchange rate between US dollar and pound sterlings. It shows that if the good money is the goods money price do not change, an appreciation of dollars against the pound makes sweater cheaper in terms of jeans. Each pair of jeans buy more sweater, while the depreciation of dollar against the pound makes sweater more expensive in terms of jeans. So you can see if the exchange rate between sterling pound and the US dollar is appreciate, it means the um the sweaters is cheaper in terms of jeans. So we do it here because we want to compare the international transaction in terms of goods and services in this table. So, and then in foreign exchange market, they also looking at the demand and supplies. So the question is, what are the demand for? So I'm not looking at the rate, like the spot rate or the forward rate, something, because I think we already know about this. So we just go directly to the important point. So in foreign exchange market, we're looking at the demand and supply as well. So the question is, what are the demand for foreign currency asset? So the demand for a foreign currency asset, or here they specifically mention about bank deposits or certificate of deposit, we say CD, is influenced by the same consideration that it's influenced the demand for any other assets. So the demand for uh, foreign currency CD or bank deposit is actually influenced by the asset and the asset returns. So what is asset returns? So asset return is the percentage increase in value of asset offers over the same time period. So the foreign currency bank deposit or foreign currency certificate of deposit is also an asset, and the demand is actually the same for any other assets. When we see asset have a huge returns, we actually demand for more foreign currency bank deposits. And the asset return is the percentage increase in the value of an asset over a period of times. So for examples, at beginning of 2020, you pay 100 for a share of stock, for example, and then if the stock pay you dividend $1 at the beginning of 2021, and the stock price increased from 100 to 109 per dollar over a year, then it say you earn a rate of return of 10% of the stock of your financial assets. So this is just an example. And then we have the real rate of returns. So the real rate of return is actually the expected rate of return that seller will consider in deciding which asset to hold. So it's a rate of return as computing by measuring asset value in terms of some broad representative basket of product that seller regularly purchase. Or we can say the expected rate of return that seller have to choose between investing in any assets. So It is the expected real return that matters, actually, because the ultimate goal of saving. So here we're talking about bank deposit. It means deposit just you save money at the banks. So the ultimate goal of saving is actually for future consumption. And the real return measures the goods and service that a saver can buy in the futures in return for giving up some consumption today. So when you deposit your money at the bank or you sell your money at the banks, it means you save for future consumptions. So the real rate of return is actually just a measure of a good or service that you can buy in the futures, because now you're giving up by not buying or by not consuming today, and you put the money at the banks. For example, if you have $10, so $10 today, if you consume it today, you can buy, like, you want to buy a burger for $3. But you don't consume it today. So you put $10 at a bank, and the bank give you an interest rate. So, for example, at the end of the year, you got interest rate, you got a return of $1. So now you have $11. $11 you can consume good and service at the end of the years, by giving up buying a burger at the beginning of the year. So this is the definition of the rate of returns. And then we consider the demand for foreign currency. We also consider the risk and liquidities. So everything else equal, everyone, including me, you prefer to hold the asset offering the higher expected real of returns. So the saver care about two main characteristics of an asset. Uh, 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 I mean, for me and for you, for example, individual household, we prefer to hold assets that offer the higher expected real of returns. But some assets, they may be valued by the saver more other than the expected real of returns. So the saver consider two main characteristics of an asset other than its returns. So the first one is they consider the risk. So the risk is actually because we know that the asset real return is usually unpredictable. When we invest in an asset, it's an investment. It's really unpredictable. It may turn out to be quite different from what we expect when we purchase the asset, for example. So we always say that high risk, high returns, right? So we don't like uncertainties, and sometimes we are reluctant to hold assets that make their wealth high variables. So the asset with high expected rate of return may appear undesirable for saver if it's realized that the rate of return fluctuates widely. So the risk, meaning that the variability, it contributes to saver wealth. So for the savers, it's different from the investor in the stock market. So saver, we are more reluctant to risk. So for those who invest in the stock market, they are risk takers. For us, for savers, for those who put money in their banks, we dislike uncertainty. We don't like risk. That's why we put money in the banks. And the second characteristic is liquidities. So the liquidity is the ease which the asset can be sold or exchanged for goods. So asset can be differs according to the cost and speed at which the seller can sell. For example, if you own a house, it's not a liquid asset because the seller usually require time and service of broker and inspectors. So cash we consider the most liquid of all assets, and it's always acceptable at the face value as payment for good and other services. So sellers, as a seller, we prefer to hold some liquid assets as a precaution against any unexpected happen in the futures. So they consider an asset liquidities as well as its expected return and risk in deciding how much to hold. So when we want to save money at the banks, we consider the rate of returns, we consider the risk, and we consider the liquidity as well. The main characteristic that why we demand for foreign currency assets. Then we consider the interest rate as well. So the market participant, they need two pieces of information in order to compare the return on different deposits, how the money value of the deposit will change, and how the exchange rate will change. So the currency interest rate is the amount of that currencies an individual can earn by lending a unit of currency for a year. So for example, at a dollar interest rate of 10% per year, the lender of $1 is still 1.10 at the end of the year. So this is the meaning of the interest rate of the currencies. So the interest rate play an important role in foreign exchange market because the large deposit traded, they pay there in the foreign exchange market, they pay interest, and each rate reflecting its currency denominations. So as I mentioned here, a dollar interest rate of 10% per year, the lender receives $1.1 at the end of the year. So it's play an important role in the foreign exchange market. So this is the graph showing just an examples of interest rate on dollars and yen deposits. Sorry, on Dutch mark deposits. So it's a dollar rate on the black line and the Dutch mark rate on the yellow lines. So you can see this is the interest rate. It means the dollar rate is actually pay higher interest rate than the Dutch mark rate. But so at some point you can see they can move quite differently over time because they are not measured in comparable terms. So sometimes they can move quite different over times. So then we're looking at in the demand and supply. Here we're looking at the exchange rate in the long runs. So exchange rate are determined in the market by the interaction of supply and demand. So the microeconomics theories work everywhere. The supply and the demand theory, they work everywhere. So an important concept that drives the force of supply and demand in foreign exchange market or in exchange rate is the law of one price. And I assume that you already know what is the law of one price as well. So the law of one price states that the price of an identical good will be the same throughout the world, regardless of which country they produce. For example, an American steel, they cost 100 per ton, while a Japanese steel costs 10,000 yen per ton. So the steel costs the same throughout the world. In the US, or in Japan's in this case. And for example, is we say now the exchange rate between Japanese yen and the US dollars is 50 yen per US dollars. And then in the US, they have American steels. So we have American steel and Japanese steel. So in the US, $100. In Japan, it costs 5,000 yens. If $200, it costs 10,000 yen. So if the exchange rate is 100 yen per US dollars, then the law of one price work. So now the steel in the US and Japan cost the same. $100 in the US cost 10,000 yen in Japan's. So it just we're not going to do this as a time constraint. So exchange rate in the long run, we also looking at what we call the theory of purchasing power parities. But the theory of PPP state that the exchange rate between the two currencies be adjusted to reflect the change in the price level. So under the PPP, when the domestic price level increased by 10%, the domestic currency depreciate by or decrease by 10%. So the application of law one price to the price level work in the long run, but actually not work in the short runs. And we will see why this happens. So because there are some problems in purchasing power parities. So the question here is, what is the exchange rate between Hawaii and Wyoming, which is the one state in the United States? So shouldn't a house in Hawaii and Wyoming cost the same? And the second problem is that all goods are not identical in both countries. Like even the same, in terms of car, for example, they have Toyotas versus Chewy or Chevrolet in this case. So Chevrolet is in the manufactured by the US, and Toyota is manufactured by Japan, but by Japanese. So in this case, all goods are not identical in both countries, even the car, but they have different names, different brand, for example. And the problem with PPP also happened because many goods and services are not traded. For example, haircuts, uh, a land, for example, or probably doctor's fee. It's not traded actually. So the law of one price or the purchasing power parity is not whole in this case. So it's just a graph showing the exchange rate and the relative price level between UK and the US. So in this case, if the law of one price or PPP hold, it should be the price here should be coincident with the exchange rate. But you can see sometimes the price is not moving that high, but the exchange rate between the sterling pound and the US dollars appreciate a lot. So it means the law of one price or the PPP does not hold in the long runs. And they have some factor that affecting exchange rate in the long run. So the basic principle is that if a factor increase demand for domestic goods relative to foreign goods, the exchange rate is increasing. So there are four major factors that affect the exchange rate in the long runs. The first one is the relative price level, tariff and quotas, preference for domestic and foreign goods, and the last one is the productivities. So the relative price levels. So in line with the PPP theory, for example, when the price of, say, the American goods increasing, in here we holding foreign price constant. So when the price of American good increasing, it means the demand for American good decreasing, and the dollar tend to depreciate, so that the American good is still can sell well. So a rise in relative price level causes a country currency to depreciate. And by contrast, for example, if the price of Japanese car increasing, it means the relative price of the US or the American car decrease. So the demand for American car will be increased as well. And the dollars tend to appreciate because the American good, the American car will continue to sell well even with the higher value of the domestic currencies. So in the long run, a rise in currency price in country price levels relative to the foreign price level cause its currency to depreciate. And a fall in country relative price level, just the other way around, cause currency to appreciate in this case. And then we have a trade barriers. So trade barrier here, we have a barrier to free trade. We have such as the tariff, which is the taxes on imported goods, and the quota, the restriction on the quantity of the foreign good that can be imported. So tariff is quota is a little bit different. One, which is on the value, and the other one, the quota is on the value. So it's a little bit different. And these two can affect the exchange rate. So increasing trade barrier cause a country currency to appreciate. So suppose now the US increase its tariff on Chinese goods. So the increase in trade barrier will increase the demand for the US goods, and the dollar tend to appreciate because now they put the tariff on Chinese goods. So the consumer has no choice. They still need dollars to buy the US good. And so the US goods still sell well, even the dollar is appreciating. So increasing the trade barrier will cause a country currency to appreciate in the long run. And if you go back to this graph, the first graph that we see, the US weighted currencies against its traded partners, you can see over time, the US dollar is increasing. The trend is increasing or appreciating against its trading partners, because from time to time, especially during the last 5 years, during the last 10 years, the US tend to impose a lot of trade barrier, especially on Chinese goods. But when you see the graph, sometime, I mean, when we look at the theory and we go back to the graph, you can see how the story works together with the development in their country as well. The third factor that affect exchange rate in the long run is the preference for domestic versus foreign goods. So, for example, if China's they develop an appetite for the U.S. goods, for example, say some good that really favor American users. So the increased demand, there is an increase in demand for the U.S. good or exports that tend to appreciate the dollars, because in this case, say the U.S. they have specialized in American oranges, for example, or in American movie against China's, and then that still increase the demand for American orange or American movies, and the increase in demand for exports tend to appreciate the dollars because the U.S. goods will continue to sell very well even at a higher value of dollars in this case. So if American they decide whether they prefer Chinese good to American good, for example, they increase the demand for Chinese good. They increase the import from China, and that tend to depreciate the dollars. So increased demand for country exports cause its currency to appreciate in the long run. Conversely, increase the demand for import cause the domestic currency to depreciate. So I'm saying here is only in the long runs, in the long run only. And the last one is we're talking about productivities. So when the productivity of a country increasing, it tends to increase the domestic sectors that produce the goods and services, especially the traded good rather than the non-traded good. So higher productivity actually therefore is associated with a decline in the price of domestically produced traded good relative to foreign traded good. So then when the productivity increase, higher productivity decline in the price because now we when we have higher productivity mean the cost of producing the goods is lower than before. So there is a decline in the price of domestically produced goods. Then the demand for domestic goods increases and the domestic currency tend to appreciating. While if the country productivity lag behind the other country, it means it spend higher cost, higher input in producing the goods. It means the traded good domestically become more expensive, so the currency tend to depreciate. So in the long run, as country become more productive relative to the other country, its currency tend to appreciate. And it works in the case of the US as well. So the appreciation of the US dollar can be explained from different dimensions because the US has higher productivity than China, for example. So this is just the summary factor that affect the exchange rate in the long run. So domestic price level, change in the factors is increasing, respond to the change of the exchange rate, depreciating, and trade barriers increasing, then the exchange rate of the country appreciating, import demands is also in reverse. Export demand is also in reverse. When there is increase in export demand, the response of exchange rate to the increase in the demand of export is the appreciation of currencies. And increase in productivity will also increase the exchange rate as well, or the appreciation of the exchange rate. Any questions? So actually in this case, the change and the response, it have several phenomena going around here. So I think if we have time, we will looking at that more deeply. Why export demand increase, exchange rate appreciate in this case. So now we're looking at the long runs. So these are happen only in the long runs, but in the short run, it's key to recognize that an exchange rate is nothing more than the price of the domestic bank deposit in terms of foreign bank deposits. So if you treat bank deposit in different countries as a perfect substitute, then all an investor care about is the expected return for deposit in each countries. So if you put money in Cambodia and you put money in Thailand, for example, and you consider both of them are perfect substitutes, then what we care about is only the expected return for the deposits in each countries in the short run. And the usual approach to analyze the supply and demand of the exchange rate or the foreign exchange market in the short run is just focusing on the import and export demands. And here we emphasize the stock of assets rather than flow of goods, because the flow are small relative to the domestic and foreign asset stocks in this case. So in this case, we're looking at the stocks rather than the flows of assets. And you already know what is different between the stock and the flow idea. So we emphasize again, we're looking at the stock of asset rather than the flow of here export and import over a short period of time, because if we compare the stock of asset and the flow of import and export transaction, the export and import transaction are small relative to the amount of the domestic and foreign assets nowadays. So we're looking at the supply curve analysis. So in this case, we start discussing supply curve. And in this analysis, we treat the US as a home countries. So in every economics analysis, we always assume assumptions. The initial assumption is really important. If you study macroeconomics, or you study IE405 and be discussing about the change in one variable to other variable, the first important thing you need to do is assumptions. So in this case, we assume that we make assumption that the US is the home countries, and the domestic assets are denominated in the US dollar in this case, and we will use euros to represent foreign country currencies. So the dollar asset supply is primarily the quantity of the bank deposit, the bond, and the equity in the United States. It's fairly fixed in the short runs. And the quantity supply at any exchange rate does not change. So the supply curve in the short runs is vertical in this case. So that's why we say here is we make the assumptions in this case. And the demand curve. So the demand curve for domestic asset, they show the quantity demanded at each current exchange rate by holding everything else constant. So particularly the expected future value of the exchange rate. So we're looking at the example. So the demand curve, they trace out the quantity demanded at each current exchange rate. And current exchange rate and the expected future exchange rate are held constant in this analysis. Assumption on this. So in here, so suppose we are in point A here, where the current exchange rate at E2 here is 1.08, 1.05 in this case. And then with the future expected value of exchange rate held constant at ET plus 1, for example, a lower value of exchange rate, say at at here, E star here, at point A here. So imply that the dollar is more likely to rise or to increase in value, or we say appreciation here. So at ET at 1 point, so we have expected exchange rate at $1 per US dollars, and then the interest rate of foreign bank deposit is 5% in this case. So if the currency is at, for example, we are at point A here, so we have 1.05. It means it's appreciating. And then at point B, we have a equilibrium exchange rate at E prime equal 1 euro per US dollars. So it's just the equilibrium, and because we have the current exchange rate and the expected exchange rate constants. And at time C, you can see there is a exchange rate of 0.95 euro per US dollars. So the demand curve connect this point, and the demand curve in this case is downward sloping, because at ET is lower, the expected appreciation of the dollar is greater in this case. So the lower the current exchange rate, the greater demand for the dollar assets in this graph. Any questions?
No question for now, teacher.
Okay, good. So the equilibrium in foreign exchange market, so it's a usual supply and the demand analysis. The market is in equilibrium when the quantity of dollar asset demanded equal the quantity supplies. So in this figure, equilibrium again occur at point B here. The intersection of the demand and supply curve at point B, and exchange rate at equilibrium is E star here. So, for example, suppose if ET greater than E stars at point A. So at point A, we see that E2 is higher than the equilibrium exchange rate E star here. So in this case, you can see the quantity of the dollars asset supply is greater than the quantity demanded. So, or we call it excess supplies. So given people want to sell more dollar assets than they want to buy, in this case, the value of the dollars is decreasing in this case. So as long as the exchange rate remain above the equilibrium exchange rate, the excess supply continue, then the exchange rate of the dollar here will force to reach its equilibriums. And the other way around, if, for example, now we have a ET smaller than equilibrium exchange rate, for example, at point C here. So you can see here that it's just the other way around. When you start from here, you have more demand than supply. So then now the demand for US dollar asset is increasing. Demand increasing means people want to buy more US dollar asset. So they need more US dollars to buy. So then the demand for US dollar increasing, US dollar become more valuable or appreciate in this case. So if ET is smaller than the equilibrium or exchange rate equilibrium, the demand greater than supply, they sell US dollars. They want because US dollar is in demands. So you can see the exchange rate in this case is having appreciations. So to understand how exchange rate shift in time, at this we need to understand the factor that shift the expected return for domestic and foreign deposits. So we will examine the change in money supply and the change in and the exchange rate shooting, but we don't have time. I'm not sure how much time we have. Probably we can continue a little bit. Okay. So for examples here. So for example, now we say there is an increase in the interest rate domestically. We say when the domestic interest rate on dollar asset increasing because people want to hold more dollars. So when interest rate of the dollar asset increasing, this will cause domestic currencies to appreciate. So you see on the graph, we start from, this is the exchange rate and this is the quantity of dollar assets. So we originally at 0.1 at E1, then the interest rate of domestic dollar asset increasing because people want to hold more dollars. It means that now the domestic currency or the US dollar is appreciating from E1 to E2, and we have a new equilibrium at 0.2 here. So the return on dollar asset increase at this time because we have increase in the interest rate of dollar asset relative to the foreign asset pool. So it means people want to hold more dollar assets. Then the quantity of dollar asset demanded increase at every value of exchange rate here. So there is a right shift of the demand curve from D1 to D2. So the new equilibrium, as I mentioned, is at D2. So an increase in domestic interest rate, ID here will shift the demand curve for the domestic asset and cause domestic currencies to appreciate in this case. And if when the interest rate for domestic asset decrease, it's just the other way around in this case. So while when the domestic interest rate increase, the relative expected return on domestic dollar asset increase, the demand curve shift to the right or increasing, and the equilibrium exchange rate rise from E1 to E2 in this case. So how about what if the international or the foreign interest rate increase? So suppose now the foreign asset pay a higher interest rate. So when the foreign interest rate increasing, the return on foreign asset relative to dollar asset is also increasing because now people want to hold more foreign asset and hold fewer dollars. So in this case, this cause domestic currencies to depreciate. And we start at 0.1, for example. So in this case, it will shift the demand curve to the left, pressure on the exchange rate to decrease from E1 to E2. So the foreign interest rate increase, the relative expected return of the domestic, or we say here, the US dollars decrease, and the equilibrium exchange rate fall, or we say the exchange rate now depreciate. And that's, so the question why it depreciates, because, for example, the US and Europe here. So now the Euro area, they raise the interest rate. So now investor, they pursue that, they have to make choice. So they pursue that putting money at the banks in euro provide them higher expected returns. So now when they holding US dollar assets, it means they need to exchange US dollar asset for euro monies. So then the demand for US dollar is decreasing. So when everyone exchange US dollar for euro, it meant a lot of US dollar circulated in the economies. So this is the transmissions from the increasing in the foreign asset to exchange rate depreciation. The question why domestic currency to depreciate. Any question here? And then when the foreign interest rate decrease, just the other way around with this graph, I think. And we have another factor is the changes in expected future exchange rate or E expected T plus 1. So when investor perceive that the exchange rate of the dollars in the future between euro and the dollar is increasing or appreciate or dollar is appreciating, people want to hold more dollars right now because they think that they can gain higher expected return in the futures. So this can cause current exchange rate to appreciate as well. So we are at 0.1 here at exchange rate E1 and the demand curve D1. So when the expected exchange rate increasing, it also led to current exchange rate to appreciate as well. So when the expected future exchange rate increase, relative expected return on domestic dollar asset also increase or appreciate. Increase, and it shift the demand curve to the right to D2, and the equilibrium exchange rate increasing from E1 to E2, or the exchange rate is appreciate. Because even though the exchange rate is expected exchange rate is in the futures, but because investor they want to earn more profit in the future, that's why they invest in the US dollar asset currently. Demand for more US dollars asset, demand for more dollars. So now dollar is more valuable, or we say the domestic currency or the US dollar is appreciate against the the euros in this case. So similar to the determinant of exchange rate in the long runs, following the chain increase in the demand for foreign goods, shifting the demand to the right, increasing expected exchange rate. So the expected fall in relative US price level, the expected increase in relative US trade barriers, the expected lower US import demands, expected higher foreign demand for US exports, and expected higher relative US productivities. So in the long runs, we have a factor that impact the exchange rate, like the relative price level, the trade barriers, preference, productivities. And in the short runs, what we focus here is only the expected fall in relative price, for example, the expected increase in the trade barrier. So in the short runs, what we do is only be focusing on what happened in the futures and what should we invest in right now or currently in the short run here. So this is just a summaries of the shift in the demand curve for domestic asset and affect the exchange rate. Probably you can have a look. So probably you can have a look here. So when the interest rate on domestic asset increase, In this case, for example, the expected return on dollar asset also increased at each exchange rate. So the quantity demanded for US dollar asset increasing. So then you see the demand curve shift to the right and the equilibrium exchange rate increasing. And then foreign interest rate increase, the change in the domestic asset of US dollar decreasing, exchange rate depreciate, and the demand curve shift to the left. And the expected domestic price levels increasing in this case. So in the long runs, the determinant of exchange rate indicated the value of dollar will decrease in the futures. So, and then the expected return on dollar, and then in this case will decrease or fall. The quantity demand decline, and the demand shift to the left, the exchange rate fall or depreciate in this case. Then you can see the expected trade barriers in this case. So if we expect that now the US, if we expect that the US will put more trade barriers, then the value of the dollar is higher in the long run, and the expected return of the dollar asset is also higher, and the quantity of dollar asset is also increasing. So you can see here the demand curve shift to the right here. And in terms of imports, so if we expect that the import demand increasing here, so we expect the exchange rate to depreciate in the long runs. So the expected return on the dollar asset will also decreasing. The quantity of dollar is also decreasing at each value of current exchange rate, and then the demand curve shift to the left. Now the exchange rate currently is depreciate as well. So what you expect in the long runs have an impact on your short run analysis in this case. So the exports increase is just the opposite occurs when with the import increasing, and then we see expected higher productivity will increase the expected exchange rate in the long run, will increase the expected return of the US dollar domestic asset, and will raise the exchange rate at currently to increase or to appreciate in this case. Any questions?
Not for
So-
now, teacher.
Okay, so if you have questions, probably you can ask me in the next lectures. You go back first and you see, you read this summary, and then you see yourself draw pictures if it works. If it not works, you come back and ask to explain again. So there is a case that we have an effect of changing interest rate on equilibrium exchange rate. So in this figure, we already see that in here, there is an effect of interest rate on the equilibrium exchange rate. So when the domestic rate interest rate increase, the domestic currency appreciate, as we see before. And when the domestic expected inflation increase, the domestic currency react in the opposite direction. It depreciate, which is in this slide. So because of rise in domestic expected inflations, led to a decline in expected dollar appreciations that is larger than the increase in the domestic interest rate. So the relative expected return on the domestic US dollars will decrease and will shift the demand curve to the left. And the equilibrium exchange rate will decrease, or we say depreciate in this case. And this analysis is actually regarded to the Fisher equation, the nominal interest rate and the real interest rate. So the Fisher equations, the real interest rate expected inflations is actually the nominal, is the nominal interest rate I equal the real interest rate plus inflation. So in this case, the nominal interest rate change for two reasons. Either the real interest rate changes or the expected inflation change. So the effect on the exchange rate is a little bit different. We're just focusing on the domestic real interest rate increase. The nominal interest rate will increase while the expected inflation assumed to be unchanged. So, but in this case, if the real appreciation of the dollars is the increase in the domestic expected inflation, it's actually will lead to a decline in dollar appreciations in this case. And then the expected return on the US dollar asset is also decreasing, leading to a decrease in the exchange rate, because a rise in nominal exchange rate increase because now we have increase in inflation. Increase in inflation will increase the nominal interest rate in this case. So exchange rate, we also looking at the exchange rate volatility, or we say overshooting. So exchange rate overshooting is important because it have explained why the foreign exchange rate are so volatile. And then another explanation actually deal with the changes in the expected appreciation of exchange rate, as anything change our expectations, such as on price level, on productivities, inflations, the expected the exchange rate will change immediately. So exchange rate respond immediately to the change in our expectations. So your expectation on price levels, your expectation on productivity, on inflations, then the exchange rate will change immediately in the short run, as well in the long run as well. So what happens in the short runs is for exchange rate is something that we expect in the long runs. So I think we're gonna stop here. I don't want to throw too much thing on you. Is it okay? We can continue next week.
Yes, sure. Yes, teacher.
Okay, good. So you go back and read the slide again. If you have any questions, we can discuss on in the next lectures.
Yes, teacher.
Teacher, do we have homework?
Today? Today, you mean?
Yeah. Do we have
No,
homework?
no. Don't have homework today. Not yet, I mean. Okay, so we will continue next week. Again, if you have questions, please you can ask me in the next lecture, or you can contact me through the chat box if you want, yeah. So So thank you for today and have a good dinner.
Yes, teacher. You too,
Thank
teacher.
you, teacher.
Yes,
Goodbye.
teacher. Goodbye.
Yeah, thank you everyone. Take care.